It's November 16th, 2018. This is episode 2 of the Market Huddle. This is Patrick Ceresna.
And I'm Kevin Muir.
Now, Kevin, why don't we start off with this week's sponsor? Who's up to bat here?
Well, this week it's the Naughty Otter Pilsner. And I just love this company. You know, as usual, we had just a wide array of different guys that were knocking on our door trying to sponsor us this week. But I chose these guys. It's a premium all-natural craft Pilsner born from the Ontario's beautiful Thousand Islands region. Created in the never-ending belief that good beer is meant to be fun.
All right, but listen. Wait, just stop for a second. What's with the name, though? Is there purposes? Like, are Canadian otters particularly naughty?
I'm not sure, actually. You have a cottage, and I also have one, and I don't know about you, but do you have otters at your cottage?
No, I don't.
Oh, so we have otters at our cottage, and the otters are always nice, and I actually like them. It's the beavers that you have to be careful about, and I know you think there's a joke to that, but and you know like what they say, what a groundhog can do to a golf course. You should see what a beaver can do to a cottage lot. Like, it's unbelievable. But anyways,
All right,
let's jump in here. Naughty Otter. That's nice. Big thank you to our sponsor, Naughty Otter Pilsner.
It's going to make it a good show. That's actually nice beer.
Yeah.
So before we go on, though, you have a little bit of housekeeping here.
Yeah, and my usual stuff. So here we go. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com.
All right, let's move on here, Kev. I need to ask you, what was the biggest thing for you this week?
Well, by far and away, it was the energy markets. It went berserk.
And it was crazy.
It was crazy. And it was crazy on both sides. It was crude oil going almost no bid. It was down 13 or 14 days in a row. It seemed like it would never end. And on the other side, there was nat gas going berserk to the upside. It just was up, it was up 50, 60% over a couple of weeks.
It was crazy.
It was nuts. So why don't we pull up some charts and have a look at these things?
Well, so first of all, this was the move on oil. Now, let's go back. I mean, what was our number one thing we were watching for this week?
Last week or
last
week's show, it was oil going to hold at $60?
And we both have a little egg on our face, don't we?
That's correct.
We both thought there's a good chance it was, but nope, it did not.
The joke was whether it was going to bottom this week, and when it did bottom, it just bottomed $5 lower than where we left
it did hit bottom. We were right, just wrong about the price level. But what was interesting was just the one day and how fast that happened. Like, we were at 60, and literally, boom, we were at 55, literally within hours.
Yeah.
It was incredible. The fastest $5. Was there a news event that triggered that?
Well, no. So there was no news event, and I wrote a post in my Macro Tourist about this. It really began to smell like a liquidation event.
Yeah.
And I speculate that it was a hedge fund, and I think we're going to find out later that somebody big blew up. And I speculate what they had on was a long crude oil trade versus short natural gas trade on. And you might say to yourself, well, why would somebody have that position on? Well, if we back up a little and we have a look at this, both markets over the last, 3 or 4 years, right, you'll see that.
Let me just quickly crunch it in here.
Right.
So this is going back to over here was the 2014 to 2015 plummet where we went from $110 down to $26.
That's right.
It was a crazy time back then. But then we've since then been going right from that bottom all the way back to 77.
And there's been a lot of kind of market pundits that have been quite bearish along the whole way. But if you stopped and thought about the Trump stimulus, all the globalized synchronized recovery, it made a lot of sense for you to think that if the economy was doing well, that oil was going to be a bid and that it was going to head higher. So it was an easy trade for somebody who was bullish on the global recovery to be long oil.
Of course.
And on the other side, when you go on the nat gas, you say, well, why would someone be short nat gas? Nat gas is one of those commodities that's like the VIX or like the grains, and it's that the carry on it is just brutal. So when we're looking at this chart, I think your chart is actual, like it's
continuous.
Is it continuous? But it's not actually adjusting for the loss of the roll each time, is it?
No, it's not.
That's right. So when you go and you try to, if you were to buy nat gas, you would be losing every month when you had to
I would
roll. And it's just like the
and
VIX.
sometimes it would be like even 5%.
That's correct. It's just like the VIX.
crazy.
If you try to go and be long the VIX, it decays downward. So if you look at the VIX index, it might be unchanged for the year, whereas the VXX or the VIX futures,
slowly.
it's every month you're just chipping
And
away.
being short that vol was the easiest trade back then, and same with being short nat gas in this scenario. So, so you're thinking that a trader, a big time trader, was basically getting going short nat gas, getting the positive carry from being short, and then at the same time using a lot of that leverage and proceeds to carry a crude oil long.
That's correct. And so this trade has worked for a long time.
That would make sense because oil was in backwardation, right? And so there was a carry, the reciprocal carry. Is that right?
I can't remember in terms of that. Either way, it wasn't a big deal. I think that the move lately on oil is being kind of exaggerated. The move of the curve has changed a lot, but I don't think that there was the same negative carry. I'm positive there wasn't the same negative carry that there was on natural gas. So it made a lot of sense if you wanted to have a positive carry trade to be long crude oil versus short nat gas. And I'll tell you one thing about hedge fund managers. They love positive carry trades.
Sure.
And the reason is that when you have to go and produce positive results every month, something that in the absence of anything else happening earns you some money is always, very welcome. So basically what I became to realize is that the action smelled this week of somebody. There's the
wood chipper.
The wood chipper. I said someone is being taken out to the wood chipper.
Is that from the Fargo?
That's from Fargo. Eh?
Yeah.
Like great movie.
Eh?
So it really began to smell like that something was going on. And the one thing I wanted to point to was the natural gas spreads. So I think it was a little more complicated than just being natural gas.
Let me just pull them up right here.
So natural gas isn't storable. Well, it is storable as a liquid natural gas, but in essence, it's not storable easily.
Yeah.
So therefore, the action between months can vary. You can have it can be very dependent on weather. So if you get a March that's very, very cold and then in April that's very, very warm, you could have a situation where there's not enough gas in March and then in April there's way too much. So the March-April spread between the 2 months is known as the Widowmaker. And it is kind
between March and April.
Yeah. Oh, yeah. That's a very famous spread that a lot of nat gas traders will trade. And often it's because March will be that one last cold kind of spell. And so you'll get a situation where you get that little bit of cold that causes the heating to kick in. And therefore, people are running their heaters and it causes a demand. And then come April, there's no more and it kind of plummets. So it's the Widowmaker. And being short that is generally, it's just kind of like being short grains in that it always trades at a premium because people are always worried about droughts. So grains are always trade kind of for more in the future because people are worried that
some event will.
That's right. So that they'll pay for that. So when I looked at the spread trading this week, it very quickly became clear to me that it wasn't a weather event. Although it did get colder this past couple of weeks, it did get colder, which did put a bid to natural gas. So there's no doubt about it. There was some effect to the weather, but
not to the March-Aprils.
That's right. So if anyone can tell me what the March-April weather is going to be like of 2019, like a year, like 4 or 5 months from now, well, great. Like you should be out trading these spreads.
It's clear that this is a trading event, not a weather event.
That's right, because when you look at this, we've kind of highlighted here, and we've shown that this spread is traded from, 20 cents to 40 cents for the past 3 years?
25 to 40.
Yeah. Then all of a sudden it blew out to 80, and then all 80 cents, and then from there it went to 160, 170, 180?
Oh, yeah, $1.70. That's crazy. But the question I wanted to ask you was this. Now, one could argue you put on a Widowmaker trade and you're putting on a March-April, some sort of spread combination between the two. But what if this was simply that trader that's long oil, short nat gas was simply out to March, and they're being trapped in one particular month and not the other. And so as they're being squeezed out of the one month, the other month doesn't move, and then the spread between them blows out. Do you really think it's a combination of the two, or do you think it could be just a nuance that there was a huge open interest in the one that was where the squeeze was underway?
Well, that's an interesting theory. It could be that you're correct, that it was basically the guy was the person that was short the natural gas was only short to March, and therefore April was like kind of just looking at us like it basically was. If you look at the April contract, it sat around while everybody else was going up and down like a toilet seat, and it could just be that those were the ones they needed to cover. Or it could also be that they were actually trading the spreads. And I don't know if anyone will know, but I do know that when you see that sort of volatility in the spread product, you realize that this isn't just kind of an orderly market. This is something that it is a big deal. And one of the ideas that I had that I'm not sure, it doesn't really make any sense, I'll just throw it out there for you, but is that the PG&E, which is a big, huge electric utility in California, they had some trouble, and they basically are on the hook for the wildfires in California. Right. And therefore, they had to draw down on a couple $1 billion line of credit. And it doesn't make any sense for them to be short natural gas, but maybe they're short the spreads. Maybe they had an energy desk. Who knows? You never know with these things. But it definitely felt like that move that we saw in natural gas was somebody that was getting forced, what we call the tap on the shoulder. Get the position off the sheets, and it didn't matter what the price was, because that was not done orderly. That was panic stricken, and that was something that
what did you call it in the blog? 1-800-GET-ME-OUT.
That's right. The trader phone 1-800-GET-ME-OUT too, because that was the broker they called to do it, because it was just demanding liquidity and the market couldn't supply it.
And if the market can't supply, you're taken to the chipper.
That's right.
All right, Kev. One last chart I wanted to touch on this. You put this chart out here. What are we looking at?
So this is what we were just talking about in terms of the natural gas curve. And what it is it's the curve at three different times in history. And one of them is today. Well, although it was today, I think I made this on Wednesday or Thursday. So that's the green line. And then the next one is a week ago, the blue line.
November 7th.
That's right. And then the other one is the red line, which is a month ago.
Right.
And what this represents is the different prices of the contracts at for different expiries. So the near one is the January 2019. Yeah. And what you can see is it's gone from the... What is that? What's that number there?
That's about 330.
330. So it went from 330
to about 420.
And then it jumped all the way to 420. And then what you do is if you look out, and let's go out to the April contract, you can see that the April contract barely budged.
Right.
And what's really interesting here is that when you go out the curve, the strip as they call it, you'll see that the prices didn't move at all. So although this is an event at the front of the curve where you're seeing natural gas spiking all around the place, it's actually only it's concentrated in the front end of the curve.
Is that no different than the oil term structure we talked about last week, which is that it went to 72 at the front, but when we went out, a couple of years, then we were still all flat around the $60 and $50 ranges on the oil, right?
It's the same, but in reverse. Because in that case, the term structure was coming in, so it was the spot was coming down the $10, but the longer term ones were staying unchanged. In this case, it was moving up. The front end of the curve was moving up, and the other ones were staying the same. The one thing that you need to think about though is if you're sitting there and you're a Canadian or an American natural gas producer, although this has helped you for the delivery of these next kind of 4 months in terms of locking in some profit, you're really cared about, you're selling the whole strip, and the whole strip is barely moved. So be careful when you're kind of translating this to the stock prices, because that's not what these things trade on. They trade on long-term expectations of natural gas price. They do not trade on the spot prices.
So is there a trade to fade this to mean revert?
Well, if you're really kind of crazy and you want to,
all right. So if you're crazy trading natural gas, find something.
You're absolutely right. Natural gas is a scary, scary contract, and it's big. The other thing is it's 10,000. like the multiplier is 10,000. So when you get this move there,
10,000 BTU.
Yeah. So when you get a move there, that thing's moved the spread is moved from 20 cents to $1.60. That's
Wow.
like,
Yeah, it's ridiculous.
Yeah, it's a lot of money per contract. So you need to be careful. But if you were trying to fade this, I would fade it with the Widowmaker.
Yeah.
Like that would be the trade to do, because I think that's the
But
part.
I mean, yeah, that's crazy. But yeah, definitely let's watch.
Yeah, that's the one to watch though. And the other thing is, people have asked me, is it over? When is this trade? If it is a big hedge fund that is trying to liquidate this position, when is it over? I contend it'll be over when you start to see the spread wind down and see it kind of
the mean reversion kicking in, which means that the squeeze is done.
That's right.
Right, because no one will fundamentally trade the spread. It's just the liquidity in the short term wiping everyone out.
And in the meantime, on Friday, it was interesting because Wednesday we got kind of the panic move. And then it looked like on Thursday we had one of the biggest down days in natural gas ever, I believe, in terms of the percentage move. And then Friday, interestingly enough, it's back up, and the spread also was back up as well. So maybe he's not done.
All right, let's move on.
So, Patrick, I think energy is the biggest event of the week. What do you think it is?
I really want to know whether this is the turn point in bonds. And for all of our listeners, the one thing that we want to really kind of go a little bit deeper on is that one of the major pricing variables into bond prices, particularly treasuries, is inflation expectations, particularly when you're going farther out on duration. Right? On the short term, it's all about Fed policy. When you're going into the middle to the longer end of the curve, it's all about inflation expectations. And so one of the big inflation scares beyond that of very low unemployment rates and the fear that there's going to be wage inflation coming into the system was the rising commodity prices. It was the fact that oil was running away, gasoline prices were very high, commodities were rallying up, and a lot of people like Kevin were calling for big inflation surges.
Well, and to be fair, a lot of people like Kevin were calling for bonds to go lower.
Fair enough. So, nonetheless, we have a situation where oil has now definitively turned. Now, look, we're going to at some point see a bounce. But I think the window has closed on the intermediate time frame for oil to go to higher prices. Like we're going to get a reaction. We're going to probably get back even to the 60s potentially on oil on a reaction. But I don't think we're going north of 77 on WTI or 80s again on Brent anytime soon. In the distant future, yeah, but in time soon. So there's two variables: a strong dollar, and a strong dollar is generally deflationary. No, disinflationary. Let's call it disinflationary. And you have commodity prices coming down. All of these things, to me, even in spite of Trump tariffs, are suggesting that that inflation expectations are going to curtail, and we're going to see them coming in lower than expectation. With that, I'll let you pine in here.
Right.
With that, if that's the case, is this the bottom on Treasury bonds? I'm going to put up a chart while you're talking.
Okay. Cool. Well, as you know, I'm an uber bear when it comes to the bond market. And
yes.
We kind of are at odds at this because for as much as I'm bearish, you're bullish. And I consider myself the Kodiak Grizzly of bond bears. So it kind of pains me to say this, but
Well, first of all, which bond do you want me to put up here first?
Well,
I'm going to look at yields, but which one? 30-year?
So why don't we just start with the 10-year? So let's just start
okay.
talking prices, and we'll look at this.
All right. Remember, so the Kodiak is speaking here. Go for it, Kodiak.
And remember, though, I've been a little less Kodiak-like ever since the Gunlock 3 1/4, 2 closes above 3 1/4 on the on the what is it, the 30-year, and then he was going to get all bearish, and he thought bonds were going to go down. I felt that at that point that there was too many people in the same camp, that it was getting very crowded. In terms of bond bears, it became very fashionable to be assuming that bonds were going to keep going down. And I thought to myself, from a trading perspective, that we could very well find ourselves pausing and maybe even rallying. And I can't say that I disagree with any of your logic about the oil causing the next surprises on the inflation side to be, disappointing. And I really believe that The market is waking up to the fact that the Fed has probably hiked into a slowdown or a pause, and maybe even hiked into a recession. And the real question is, how do you go about taking advantage of that? And I think this is where you and I are going to differ a little, and we're going to go through it and do a little bit of, I'm going to show you my side of the story. And I think that if I might put words in your mouth, you would say you should go out and buy the longest duration bond you can find, because it's going to give you the most oomph when the rates come down. Am I correct?
I mean, in the basic premise, absolutely.
Right. Whereas I look at it as saying, I'm a little more nuanced. I think that we're going to get a situation where long rates might not come down, but short rates might come down. So therefore, to me, I would rather buy more of a shorter rate bond and use leverage than to go out and buy a 10 or a 30-year bond to get the same sort of price movement.
Fair enough. So if you're going to, so you're like, want to play the fives?
Yeah. So my
okay. First of all, we got a chart here. This is the 10 years. So we saw that during the entire cycle going back to 2016, we went from a 1.3% interest rate yield to 3.20. I mean, more than a solid doubling in yields over that time frame. And that's the 10-year. If I quickly here put up the 5-year yield, the 5-year bonds went from basically 1% to 3%. Wow, that's a big move. And now the 5 years also, is it not like explain to me if I'm wrong on this, but is it not more of a tug of war once you're getting into 2s and 5s, because there's the pull from the Fed rates.
That's right.
And then on the other side is the pull from inflation, while the 30 years much more of a call pure on inflation. Am I right?
You're absolutely correct. The longer you go out, the more it's
all about inflation.
It's all about inflation, and the closer you are to the front end, it's just a function of what they expect the Federal Reserve policy to be during that period. So why don't we pull up the chart that I created in the Bloomberg, and we can just have a look at it, and we can go through it. And what I've done here is I put the 5s. And so, I can't see the numbers very well. Patrick, why don't you tell me where we started and where we ended?
We're gone from about, about 75 basis points up to 3%.
Right. So in 2016, we were 75 basis points, and we're now, around 3%. So that's been a lot of tightening. And that's been done by the Federal Reserve, basically being the tightest central bank out there by far. Everybody else is on hold. Maybe Bank of Canada's a little bit, and there's a couple others, but the major other ones are all, central banks are all on hold. And meanwhile, the Federal Reserve just keeps hiking and hiking on their schedule. And that's caused the short end, the 5s, which is in between, to actually rise a lot. Now let's go to the next one, and we can see this is the 10-year. And you can see that the 10-year has gone from what in 2000
down to 1.3.
Right, so it went from 1.5 to 3. So it's slightly, the 10-year you're getting slightly more than a 5-year. But if you stop and think about it, it actually started from a higher level, right?
Right.
So it's risen less than the 5-year in terms of yield, right? Now let's go to the final chart. This is the one that really will drive it home. This is the 30-year. And so the 30-year started 2016 roughly at 225, and it's now kind of 50 basis points higher. So in the period when, in the past 3 years, when the 5 has gone up, what is that, 225 basis points, the 30-year has only gone up 50 basis points.
That's called a flattener, right? Because the whole point is the farther end of the curve is not moving, and it's the middle of the curve is catching up, and you're flattening. Right? Like, so you're just demonstrating the flattener.
Right. And the other thing that I want to demonstrate is that go look at 2013. 2013, the 30-year was actually higher in terms of yield.
Let me see if I can get a little laser pointer right here.
There we go. And so you can see, up here you can see that so it's just because the 30-year, even though the Fed's raised 225 basis points in terms of the 5-year, the 30-year is actually lower today than it was in 2013.
Right.
So the Fed's
But that's inflation expectations not playing into this.
You're absolutely correct. So let's go to the next chart, which the next chart is, you can see this is this flattener, and this is the spread between the 2 and the 10-year.
Yeah.
So it's one minus the other, the 10-year yield minus the 2-year yield.
Yeah.
Okay. And you can see that, at one point, in 2013, it was 250 basis points, and that's fallen all the way down to 25 basis points.
Right.
And let's go to the next chart, which is the one that...
Before we leave this, what I wanted to kind of touch on, there's a lot of people out there that like to talk about the idea that a recession can't come until we first see an inversion, and then we will have a year or so after the inversion, and then the recession will come. And one of the things that I know that both of us have both agreed upon, that we agree maybe a little bit too much for the show, but is this idea that maybe this time around there won't be an inversion.
Right. So let's first of all define inversion. Inversion means when the 2-year goes above the 10-year yield or whatever, yield curve or
so you get a
yield
negative,
spread. So you get a negative yield curve, and at that point it's signaling that the Fed has taken rates above the what the market is determining is the proper rate of interest. So, and that often means that the Fed is very restrictive, and then a recession is soon to follow at that point. Well, not soon. It can sometimes take, it can go inverted for 9 months. I think a year is generally how long it goes before it finally kicks in. But the other interesting thing that you just touched upon is that if you look at since... we're in what's known as a balance sheet constrained economy, meaning that the world
managed economy.
Yeah. So the fact that there's so much debt out there has made it so
250 trillion to be exact.
Yeah. And the fact that there's so much debt out there has made it so that the economy is much more sensitive to rate hikes.
Yes.
So it could be that it doesn't take as much rate hiking to actually slow it down. And if you go look at Japan, and Japan was kind of in a lot of ways is just kind of a decade or two ahead of the rest of the world in terms of they were the first ones to deal with ZIRP, zero interest rate policy.
Yeah.
And they were the first to
buy stocks onto their balance
sheets. That's right. Or they were also the first one to do quantitative easing out of the main thing. So
they're at the more mature stage of the debt super cycle, as Ray Dalio would put it.
That's right. And they're kind of leading the way. And so if you look at their yield curve over the last 2 decades, it has not inverted
at any point. I think you wrote the blog where you're saying the last 6 Japanese recessions were all without an inversion.
Right. So there's no doubt that there is a very good chance that we're in a new economy, and that this new balance sheet constrained economy is going to find a situation where it doesn't necessarily need to invert.
So let's move on. And this is now the 5s and 30s.
Yeah, so the 5s versus 30s. So this is my favorite trade because to me, the 5s are the part that have been hammered the most. That's the point that people have assumed that the Fed is going to keep raising, and they're going to keep raising aggressively. And so to me, I look at the 5s, and they give you the most juice because I don't think the Fed's going to go cut tomorrow. So it's not like in fact, they're going to keep raising rates. So I still think the next 2 kind of Fed hikes are still priced in there. But the good news is that that's already in the 5s. You don't need the Fed to actually stop raising rates for the 5-year yield to actually go down, or for the bond, for the note
yield
to
top,
right. All you need is the Fed to slow down the rate upon which they're hiking.
And it's interesting. If I can just put in a chart, when you look at the euro-dollar LIBOR markets and what they're forecasting for next year's rate hikes, this is the spread between for 2019. It's the spread between the December 2018 to December 2019 contract, and so the spread between them is what the LIBOR futures markets are pricing in for potential rate hikes.
That's right. And so for people who don't realize, LIBOR is London Interbank Offered Rate, which is basically US dollars overseas.
And so it's the most liquid money market in the world,
correct.
right?
And it trades very similar to Fed funds, not quite on top of it because there's a credit risk involved in it because it's
that's called a TED spread.
That's right, because it's the banks, but it trades very close. So what Patrick is saying there is that this is the difference between the 2 months, a whole year of this year versus next year. So it's how much tightening the market expected.
Or is pricing in.
Was pricing in at that point. And so when it was pricing in up there at the top, what was
60 basis points.
60 basis points.
And literally in a month, we're down to 34. They literally withdrew an entire rate hike out of the market in the last month.
And that's a function of a few things. That's the Fed. I think that this last week the Fed blinked, and I know that there's going to be some people who disagree with me, but I really do think that the Fed, Powell came out and he, for the first time, acknowledged that some of these things were affecting the U.S. economy and that the global slowdown was going to affect it. So I think that the other thing was that the credit spreads blew out and the stock market finally sold off. So we saw some the monetary conditions tightening and the market started to be worried about it. So I think that's what caused the Fed or for expectations.
Do you think now that the bond market, like I always say that the bond traders are much smarter than the equity traders, and I would imagine the bond traders will sniff out a recession long before any equity traders notice. And so do you think that this is the sign that the bond traders are sniffing out an economic slowdown? Let's not call it a recession. We don't want to be boogeyman. Is this the bond market saying a slowdown's coming and they're really now starting to get worried about it?
Well, I think at the very least it's the bond market assigning a higher probability to that event. Yeah. And you see that with credit spreads blowing out. You see that with things like this, with the spread between the next year's tightening kind of coming in. You see it with the curve steepening. And I think those are signs that they're realizing that the Fed might have tightened into a slowdown.
So your trade, let me get this straight. Your trade is go long 5s against a short 30?
That's right. That's one of my...
No, but now how do you put this on? How do you size this kind of a trade? What's the ratio you have to do to get this thing to work?
So what we're going to do is we're going to go look at this next screen. And so we'll start with 2s versus 10s. So what this is this is the two futures, which is the bottom one is the TUZ8, which is the 2-year note, versus the 10-year bond future. And what it is you can see that the Bloomberg figures out our ratio there. So it's 100 versus 52. So you can, in essence, do it 2 for 1. If you wanted to be perfect, you could do it.
100 to 52.
But the reality is it's 2 for 1. And so what that far right column says basis point value. So that means for every move in 1 basis point in that yield, how much you'll move in terms of dollars. So if you had kind of 100 of these TUZ8s, or it's probably 100 basis points, you would move $3.82 million. And then on the other side, the TYZ, you'd move minus $3.82 million.
Yeah.
So whereas a lot of people would say, oh, I'm all, the economy's going to slow down. I'm going to go buy 30 years because they're the ones that have the most zip in terms of if interest rates go down. I would agree that if interest rates go down, that the 30-year would give you the most zip because it has the longest duration. But as we saw from the graphs, that they don't always move all together like we think they do. Yeah. You could have a situation where the 30-year actually stays here, and the 5-year goes down. So we could have the 5 years.
So is this a trade for a bear steepener?
Well, a bull steepener, right? Like we would assume that we're going to get a situation where bonds are going up, and the 5 years are going to go a lot faster than they are the 30s.
But you have to own twice as many. So if we were, for our listeners that are just retail investors, that would be the equivalent of, let's say we were taking the IEI, which is the shorter duration bond ETF.
Right.
versus the TLT, which is the longer duration. And to pair this trade at a 2-to-1, you would basically go long twice as much of the IEI and short 1 unit of the TLT.
Assuming that was the duration, but we don't actually know what the durations are for those, right?
Yeah, but I'm just saying loosely in their mind.
Yeah, loosely in their
minds to think about what you're trying.
Because what I worry about is that if we get a situation where the economy rolls over, and all of a sudden it looks like the U.S. government and all governments, in fact, are going to have to spend more to finance those deficits.
Right.
And not only that, if we get a situation where the market starts to worry about inflation more, what's going to happen to the curve? The curve is going to get steeper, because let's just stop and think about this intuitively. If you are a long bond investor, if you're somebody that's investing in 30 years, apart from default, and let's just assume now for a second that the government can't default because they can always print more. What is your biggest worry? It's inflation.
Yeah.
Right? That's what's going to eat away at your return. So when the Federal Reserve is tight, meaning when they're going and actually raising rates prudently to keep inflation in check, that's why that's why the 30-year gets bid up, why it goes down in yield, because investors are confident that inflation will never get out of control.
Right.
So if you are worried, as I am, that eventually the end game is inflation, and that eventually central banks will all be forced to leave rates very low at the front end and to create the inflation that our society so desperately needs because of the reality of the huge amount of indebtedness, I think that the end game is that we're going to get extremely steep curves. I contend, and this is kind of my comment that people think there's no way this is ever going to happen, but I contend before this is all through, yield spreads are going to break out to all-time highs, meaning that we're going to get wider between the 2s and 10s and the 5s and 30s than we've ever been. So
that's interesting.
So I could see a situation where the 2s are stuck at 2% or 3%, and the 10s are 7-8%. So whereas a lot of people will say, I'm going to go buy 10s because I think the economy is going to do badly, I say, no, I don't think you should buy 10s because I'm worried about the fact that the governments have to be financed.
Okay, I'm going to push back on you a little bit because I don't know if I fully... Look, if you believe that the governments that need to turn to the capital markets to finance themselves, then I could buy your entire scenario. But one of my narratives is that we've transitioned to a managed economy, and central banks are going to provide almost all of the liquidity and all the money that governments need to maintain stability in there. And so in my mind, I'll completely drink your Kool-Aid. I would drink your Kool-Aid if I believed that they had to go and actually finance it from the actual free markets, and you had to go and dig up investors and do all this. But I just don't believe the central banks would ever allow that circumstance to arise without some form of operation twist, some sort of some sort of an operation to massage the curve to where they wanted it. I just don't believe, like, you literally in order for your scenario to happen, you have to believe in free markets.
Well, you're right in that is the biggest risk to my scenario not playing out. And what I will tell you to that, though, is if that happens and if they peg the curve, which is in essence what they're doing, and they've done this in Japan.
Yes.
Because they've gone and they pegged the 10-year.
And I do believe that we're actually moving toward Japan. This is where me and you will have many debates in the future shows, because I'm more of in that deflation camp, and I feel that we're all turning a little bit Japanese, though in different ways. Though it's not going to be a mirror image, but I think that it's a lot of what we see happening there are going to be many of the things that we're going to have to come across.
If they peg if they go out and peg the curve, which they very well might, then what you'll get is more inflation. because they'll be pegging the curve below.
Like Japan style inflation, just running away. It's crazy.
Well, no, and so Japan is a little bit like of a
It's different. It's different this time.
No,
right?
and the one of the reasons that Japan is being able to do all that is that they've been doing that in the midst of fiscal tightening throughout the world. And so you have to realize that while they were doing QE, the rest of the world was doing, everything but QE. And not only that, Japan had a situation where they were stuck with a demographics that made it very difficult for them to get any sort of inflation going. And not only that, every time that it tried to get going in terms of their fiscal stimulus, they went and actually withdrew it. Yeah. So I'll take the other side of your trade because it was a very different time, and we're now at a point where everyone's spending, and Trump has led the way for fiscal deficits. Fiscal deficits are coming. Fiscal stimulus is coming at a time when you're saying that they're going to go and peg the 10-year at
I'm
a
not
lower.
saying they're going to do it now. I'm just saying they're not going to see record blowouts without thing. Anyway, listen, I really think that this is going to be a great stuff to watch because I think we're at a crossroads and we're going to start seeing a new trend emerge, and we're going to get the opportunity to call the play-by-play. What I wanted to ask you, okay, so this was the first of these duration trades, but what is the second one we're looking at?
Well, the second one is the 5s versus the ultra long bond, which is the 30s. And you'll see there, if you do 100 of the 5s, you only do 18 of the 30s. So that just goes to show you that's your point about the amount of juice that is there in terms of the long end of the curve. It moves a lot more. So you need to do, 50 times as much? No, 5. Right?
No, 5 times.
5 times as much, right?
You had one too many.
Yeah, that's right. Our
naughty otters.
It's okay. I don't do anything with numbers for a living anyways. It doesn't matter. So you can see that you need 5 times as much, whereas with the 2s versus the 10s, you needed twice as much. Yeah. And people should be aware because what I wouldn't like to see happen is people to be all bullish on bonds and then go out and invest in the longest duration bond that they can find and then have that rate actually go up on them, and that actually being a negative investment where they could have gone and traded the instrument that they actually thought was with the rate that they were watching, which is often the overnights. Or
in a future episode, maybe we should go into not only the futures market but the options on the futures and actually see how people can engage these different bonds and see where there's a really interesting way to put this trade on using some of the different option contracts that are out there. Nonetheless, let's move on. It's time for This Week in Trading History, Kev. And so what did we dig up this week?
Well, we managed to find something that wasn't another market crash.
Wow.
I kind of laughed because you picked 3. I think I let you pick them all, and each time you picked a market crash. So when I told you This Week in History, I said no more market crashes. So you gave me an option. I chose this one, which is it was November 14th in 1972. Right. So I think it was a little before your time, right?
Yeah, a little bit.
Yeah. I was 2 years old at the time, and the Dow Jones Index closed above 1,000 for the first time. And what was interesting about this is that let's go and have a look at the chart.
Right. Well, this is the interesting part because one would think we closed above 1,000, it's just going to keep going, but it was actually in the 1970s was actually quite the bear market. And what this bear market was hidden by was the fact that there was massive inflation in the 70s. On an inflation-adjusted basis, I think I read a stat somewhere that the stock market lost 90% of its value. But because inflation was roaring so quickly that the nominal price stayed afloat, the devastation on that basis in the 70s was crazy. So what we see is in 1972 we hit 1,000, and like this chart shows, a decade stayed at 1,000.
And as you say, at that decade was one of the highest inflation decades ever in the history of North American markets. So if you put $1 in 1972 and then watched kind of 5 to 10% inflation for the next decade, you might still have your dollar after that decade, but it was inflated away.
Interesting. 1971 was actually, to one degree or another, a new monetary system being put in place when Nixon closed the gold window.
That's right.
It's the fiat currency system was born. Gold was ripping in this kind of window, and Volcker was taking interest rates. What did he take? Treasury rates to 17%?
No, but he wasn't until there was Burns and somebody
Yes.
else before that.
He came in
He
in the late
came in at the end there,
Yeah.
and it wasn't actually. I think he was the late 70s, early 80s, and then he sold
79 or something.
Yeah, he
where
sowed
took-
the seeds for the next rally that was as inflation was batted back down. The other interesting thing is that we talk about 1972 about this move above 1,000, but look back to 1965. 1965, it was 1,000 as well. So that's 1965 all the way till 1984, and that's
almost 20 years.
Yeah, and that's one of the things that I really believe that people should be more aware of, is that you might get a situation where nominally you stay even, but that you lose against inflation. And that's often one of, like, Canadian real estate is one of the best examples. People ask me, what do I think about Canadian real estate? And I often say, I think that nominally it might be fine, but in real terms it might very well go down. Yeah. And what's interesting is that my father, I grew up at a household, and he was the research director at a kind of a small boutique brokerage firm. Although I guess they wouldn't consider themselves a small boutique brokerage firm. It was actually Richard and Greenshields in Winnipeg. But and he tells me the story of how miserable everyone was, and how it was just so terrible during this period, and how it just couldn't go anywhere, and it was just the most god-awful place.
We just said that we weren't going to talk about a market crash.
Well,
and then we get into the Dow making an all-time new high. And this sounds awfully similar, doesn't it?
Well, it is slightly different, though. It's not a crash. And it's something that I actually think it's a great point that you brought up, because I think it's a much more likely scenario for the current environment than a market crash. And
this is where me and you differ in a really big way. I just don't buy that we're going to see high inflation prints. And you, on the other hand, are totally in that camp.
And I don't know about high, because everyone always thinks that high means 20% or 10%.
No, I'm not saying the high that way.
But I think
I'm thinking you're thinking north of 5.
Yeah, I'm thinking ultimately we're going to get a decade of 5 to 10, just like we did in that period. And I think that's going to do a lot to do the great debt reset that we're looking for. You go figure out, and you just talked about 90% of your value of your wealth getting inflated away by the inflation of that period. And if we do that same thing, it's going to also inflate away the debt. And I'm not saying that that's what should be done. I'm just thinking that over the course of history, that's what's been done.
Great stuff, Kev. Let's move on. Now it's time for our WTF video of the week. Let's just start off by watching it, and then let's get into the comments after.
I think those who really sort of dismiss it as, hey, look, there's no tangible value for Bitcoin, are really losing some perspective. It's not that different than in the 1990s, someone saying Amazon is worth nothing because they actually don't make money. And as you know, if you look back, that was really the bear case for Amazon throughout most of the 90s and 2000. So we still think Bitcoin is easily, on a long-term basis, the easiest way to look at it is as a replacement or a store of value. And so it's going to, as the millennials discover and generate income, they're going to use it as a replacement for gold. So if it gets 5% of the gold market, that's roughly $50,000. And we think by mid-2018, we're going to be part of the way there, and that's why we get 20,000.
All right, you have a stock market that's on fire right now. Tom, would you be buying Bitcoin over stocks at this point?
I think you want to make stocks your primary risky asset for most investors. But I think even on a risk-adjusted basis, I think Bitcoin is going to easily outperform the S&P.
Tom, how much higher by the end of the year?
Bitcoin, if it can actually rise close to 30% in just the first half of this year, I think the second half of 2018 will see a move bigger than 30%. So I think Bitcoin is still something you want to own through the middle of the year and through year end.
All right. All right. Well, okay. Thanks for putting that together, Kev. You know, I've for a long time been someone who's just never drank the Bitcoin Kool-Aid, and to be honest, there was some people that did make some good money on the way up there,
unbelievable.
and I wasn't one of them. I'll openly admit that, right? But what's amazing is that during this bubble on Bitcoin, it's amazing. Isn't it amazing how history repeats itself over and over again in the markets? Like whether this is Nortel shares or whether
Forget Nortel. I've been saying this was tulips all over again.
Oh, the
like,
tulip.
Like at least
yeah.
Nortel had a value, and don't send me all the Bitcoin guys. Don't send me messages saying how there's all this value. I think Bitcoin is a solution in search of a problem. And you might say I'm a neophyte that doesn't know what I'm talking about. The reality is that you can go and Google my blog and have a look at my Bitcoin story, because I'm the fool, the idiot that got told about Bitcoin at about 30 cents from the computer science genius that sits beside me. He told me this idea. I told him that was the stupidest idea I've ever heard, and that he should go back to programming. And he came back to me and he said, you know, that idea that you told me was stupid at 30 cents? Well, it's now kind of $20. And I said, oh my goodness. And then kind of a week later it was $50. And I said, oh, geez, I might not know much about Bitcoin, but I do know that if it's $20 or $50, there's nothing stopping it from being $500 or $1,000 or even $50,000. So I did understand about bubbles, and we actually have a great story. And I won't go on about it too much, but we became miners. We traded it. We did arbitrage. We did a million things with it. So it's not like I don't know it. But along this whole period, I just can't get my mind wrapped around buying bits in the sky. Like, it just makes no sense to me. And you're gonna and ultimately, this is what it comes down to with me. They'll say, "Oh, the supply is determinate, it's
finite.
limited, it's finite," and no, it's not. There's a new Bitcoin. There's a new different fork. There's a new different product. The supply of cryptocurrencies is infinite, and therefore, to me, it's just like it's. Like, I understand why if you're in Iran trying to get your money out, it makes a lot of sense, or Venezuela. So don't get me wrong.
It's a great tool for moving money around. Like when okay, forget the money laundering, forget the drug dealers using it to do. But it was used as a tool to, let's say, get around capital controls. So when the Chinese government puts up capital controls to remove flow of Chinese money out, well, they would turn around, flip the Bitcoins, and they would move the money through the crypto out of China, and there would be a whole market for it. So, like, this thing was a tool for circumventing the establishment.
Right. But it became a life of its own. It became just something that and there's some very famous people that just drank that Kool-Aid that you were talking about, like Novogratz, which is a big macro trader. He just embraced it wholeheartely.
Wasn't Mark Hart a huge...
he might have been. There was a whole bunch of them that just loved it. And it's funny how they've gone a little silent now. Well,
I mean, look, that bubble this is about as historical of a bubble as you get, with this kind of a parabolic rise. And on the other side came the blowout. Now, it was on Macro Voices in November and December of 2017, where we were talking about how crazy it was. And I came in my 2018 market forecast video, where my number one out of my top 10 market forecasts, my number one forecast was that Bitcoin was going to lose 90% of its value this year.
Nice.
That was my number one forecast.
So what do you need?
It's still on record. And so with it having been up near 20,000 at the time, I obviously needed down to 2,000. We're down. We broke a kilo. We're down to 5,000. I only need 3,000 more points to be right. But would I be really wrong if it only goes 80%?
No.
Right,
great call.
It was
terrific call. Because you know what? And people go, "Oh, it's so obvious." At the time, it was so difficult to make that call. You just got berated, and just like it was. You got raked over the coals. Like, it was just awful.
You know, everyone's saying, well, it could go to 100,000.
Yeah,
right?
well, that was Tom Lee, right? Like, your favorite guy.
Yeah,
and for those who don't know, Patrick just loves Tom Lee. Send him Tom Lee videos. He just loves listening to that guy.
But there were a lot of really smart, like, I mean, okay, you take the billionaire from Interactive Brokers, was it Pefferly, or what was his name?
The fellow that owns Interactive Brokers?
Yeah.
But he wasn't...
No, he wasn't bullish. He was just pointing out that, look, when these bubbles get crazy, these things go, you just don't know how high a bubble will go before it blows out. That's the point he was making, not that he was bullish Bitcoin at the time. And the point being was that the bubble does what every bubble does, which is that there's the pop, and then there's this massive mean reversion of all of the craziness, and there's people that are unfortunately being hurt by this. And we don't mean to, I don't mean to in any way wish any ill will on anybody, but realistically, these cryptocurrencies are just not the future. The one thing Eric said during one of our Macro Voice podcasts was, you know, that the existing cryptos are a lot like the Palm Pilot of the handhelds. You know, at the time it was the hottest thing, but then new generations, new technologies, new things develop, and this idea of this cryptocurrency, there will be probably many different forms in the future. But if one thinks that 20, 30 years from now, it was going to be this Bitcoin technology that was made back in 2000 and what was it, 2010 or 2015 when it all started, I just don't buy it. I think the thing. Anyway, any last comments that you want to make?
Well, no, you're right, and we shouldn't. There was some people that really got sucked into it in a big way. The people that aren't experienced in the markets, and I saw one family that sold their house and put it all into Bitcoin, and it's. And there is going to be some devastation that way, and it's you should never. The lesson learned from that is that you should never have too much of your wealth tied up into one asset, and to drink the Kool-Aid.
Without put protection.
Without put protection, you're absolutely correct, and that was the problem. But that was this week's video from Tom Lee with a little help from Seth Rogen and Snoop Dogg.
Kevin, time to move on. Tales from the trading desk, and I put this one onto your plate because we were just talking nat gas, and there's a great nat gas story that isn't a 2018 story. So why don't you take us through this Tales from the trading desk?
Well, it's a good Canadian boy, and Brian Hunter, and I think he's probably has the dubious honor of losing the most out of any Canadian hedge fund manager. And there you go. We had trouble finding pictures of him, actually. He's not, he's kind of one of these guys that it's difficult to find. And I had to put up this one of him with the Laker.
Yeah,
the Lake,
that's a nice Laker,
the Lake Trout. Yeah, that's a big, he must have gone. He's from Alberta. He was a good, Alberta boy, and that's a good big Laker, so I was pretty impressed. But one of the things that I kind of, before we go any further, I got to point something out. So we grabbed his screenshot from his Wikipedia page, and I don't know if he wrote it or he got his mom to write it, but like it's just, if you're trying to, not appear like a douchebag, like early life, and Hunter grew up near Calgary, Alberta, and earned a master's degree in mathematics from the University of Alberta. Okay, so far so good. Okay, talking about your degree is nothing wrong with that. And then he goes, he owns a Ferrari 430 Spider and a Bentley Amage. I don't even know how to say that. Is it Amage? Amage? I don't have a clue. I don't.
But still, it's like that's like one sentence. That's in there.
Put that in himself, or did he get his mom?
Well, it's not only that he's got a master's degree, but he drives a Ferrari and a Bentley.
That's right.
That's and I love this guy already.
Yeah, no, you kind of laugh. And actually, I do know people in Calgary that talk about him, and he's quite the he's quite the guy running around in these fancy cars, and he's known on the Calgary circuit and stuff. So I don't think that he's somebody that just kind of quietly retreats, and that's probably why he's talking about his cars. But anyways, let's talk about what he's done, because He is famous, and the numbers that he lost and at first made, and to lose that much money, you have to first make it. He worked for a firm called Amaranth, and I think Amaranth is a type of flower that is constantly in bloom, if I remember correct. Something like that. It's one of those hedge fund names that the fancy names and. Anyway, so he went and he started trading nat gas, and he traded those spreads. He loved the Widowmakers, and he traded them in huge size, and he made himself. I can't remember in 2006. He was one of the largest traders on the NYMEX. He was long 1,300 futures contracts and 19,000 of the ICE swap contracts. And he's allegedly, I'm not sure what the legal thing about this is, because it was never actually closed. But he was accused of trying to bang the close. So banging the close means you basically go and you take all your order and you try to achieve a certain closing price by hammering it or buying it right at the close.
Right. So you push it and then it closes at that price.
That's right. So he actually was trying to manipulate the price of natural gas, and he did this numerous times. He ended up losing. Where's the number here on how much he lost? They had $9 billion of assets, and then the value plummeted to 3.5. He lost about $6 billion
with a B.
Yeah, and it was quite the epic downfall.
Did he have to give back to Bentley?
No. I guess it's still in his Wikipedia page, which if you read it on Wikipedia, must be true. But my favorite part of this about my whole Brian Hunter story is this fact that the FERC, the Federal Energy Regulatory Commission, asked him to come down to the U.S. to answer some questions. And here's what they said. This guy says, I'm quoting from the Global Mail article. He was in the middle of an interview, and there was a lunch break, and he never came back from lunch. So he just picked up. He said, a spokesman for Mr. Hunter said he voluntarily flew to the USA to meet with FERC officials and gave an interview. But then he ended the interview when he and his attorney became aware that the FERC had misrepresented the agenda for the discussion. So, I think the rumor is in the hedge fund community that he doesn't go to the States anymore, that he's still wanted on these things. And I'm not sure if that's true or not. But anyways, he's just...
$6 billion.
Yeah, so it's just... and he did it all on the spreads. And kind of one of my favorite parts about this story is that it was in a very illiquid contracts. So he was trading things that were
that he can manipulate.
Yeah, and for a long time he was the big fish, so he could move prices around and he could do it. The trouble about being a big fish and moving prices around is that sometimes there's a bigger fish. And there was actually another trader out of Houston that figured it out. And these guys went and they realized that he was moving around these prices, and they actually went and took the other sides of his trades. And the fascinating thing is that it was in these contracts that were way out in the future. And so it wasn't like there was really, who knows who was right fundamentally. But the thing was that the other hedge fund had more money and could basically squeeze them out. So the other hedge fund squeezed him out, and
it's amazing how that is. Like a lot of retail investors always feel that they're the ones that are the ones being picked on, like that it's a small guy. But in the hedge fund business, one big trader taking out another big trader in some sort of a cornering of a market is the glory trade,
right? And because if you think about it, if you're trading in big size, and someone pushes something to a price that's not, that they're vulnerable. If a retail guy moves something around a little bit, it doesn't matter. You put it back into it's really easy to move it back, but you don't have the liquidity to do a trade. So what you need is another guy another big kind of fish to move something in a size that you can actually make enough money on.
You know, I'm next week. I want to talk. You know, I'm thinking of another story. Actually, well, let's save that one for next week. Actually, I'm not going to even say it. I'm going to leave it for a suspense. But there's a great story I want to talk about there. Is there something else you want to mention?
No, but just Google Brian Hunter and Amaranth with the natural gas
Google it.
trade.
Why don't you just go to Wikipedia?
Yeah,
'Cause that way
Wikipedia. Why doesn't someone change that and see it just as a joke? Put it in like a Hyundai Sonata and something like that, and see how long before Brian Hunter gets all mad and changes it back.
All right, let's go on.
Okay, Patrick, on to top 5 things to watch. And this week we're going to try something new. We're going to actually go through last week's and see how we did. We figured it was kind of unsporting to just kind of say these things and then not follow up.
Absolutely.
So let's go through this. Home Depot earnings. We said they were something to watch. You know, I'm a big housing bull
and I'm not so much.
Yeah, and everyone's laughing. Actually, your members, they love giving me flack about it. But
okay, one email. All right, come on, give me a break. All right, anyway, there are I'm sure others.
So anyway,
I'm not alone on this. So anyway, Home Depot did beat though.
That's correct.
So they beat on earnings.
So I was right, right?
It raised sales outlook, and supposedly consumers kept spending on homes.
That's right.
But the stock went down on there.
That's right. So I'm not really right. I don't consider it a win
okay.
when
one of the interesting things we'll make these short, but one of the interesting things is that when analysts keep lowering the bar, then it's easy to say company beat, because when they spent the last 9 months keep lowering and lowering the target, well, it's so easy for the company to step over. Really, this idea that they beat earnings, I don't like it. The truth is the market does the talking, and the price did not respond well to it. So right now, at least, continues to be weak.
I'll take the other side of that though and say the price, considering the bad tape, it didn't do that badly. But we'll wait to do it.
Okay, so number 4.
Yeah, the natural gas. Is the breakout real? Well, I guess it was.
I guess it was.
Yeah.
The question, though, is that, okay, it was real, but the one thing I'll ask you this, okay, the price obviously blew up because of the squeeze. It's a liquidity event.
Right.
But is this a more legitimate new bull market in natural gas that has a real bigger picture view? Because that's more meaningful than a liquidity event, because a liquidity event will mean revert once this trader is squeezed out.
Well, I think you have to look at the whole strip as we explained before, and the fact is that it wasn't moving, so I have trouble getting real bullish on thinking that anything really changed that much apart from somebody getting squeezed out.
All right.
Number 3.
Well, the dollar did break out to new highs, but look at that. We went 4 days, and we're now back down to the trade range. I'm not saying that it still can't go higher, but really one of the things I wanted to see was follow through. I wanted to see the dollar continue higher. So far, it's been giving back. It's not broken any Fibonacci zones or anything to make me bearish, but it's not the kind of follow through I wanted to get really excited about.
So for me, the dollar was the big news was this week the Fed's signaling that they were going to slow down the rate of increases and they were going to pause. And that
didn't come from Powell though, did it?
Well, it was a little bit of both. Like it was Powell and then it was Kaplan today, and it really though had to do with that euro dollar chart that you showed, the difference between how much tightening there is between the next year. And to me, that was why the U.S. dollar couldn't keep going, because it looks like the Fed might be pausing.
So number 2, the yield curve. What's going on here, Kev?
Well, we wondered if it was the steepening would resume, and it for sure did. And one of the things that this week, actually, we didn't talk about this while we were discussing the yield curve, but there was some whale trading in the futures market in terms of guys putting on the steepeners.
What's interesting is the 2s and 10s aren't steepening the way let's say 5s and 30s.
You're right, because the 2s, don't forget, are more affected by the Fed policy, and the Fed might just slow down and pause here, whereas the 5s are a little more going forward.
Anyway, when you go a little farther on the curve, the 5s and 30s, definitely steepers on your favorite way to put this trade on. It's still steepening, so definitely underway.
Yeah.
And then
number 1.
Yeah. Oil, did it bottom at 60? It didn't. may have bottomed, but definitely not at 60.
Yeah, no, we were definitely a little early on that. You know, when we both agreed, we were laughing about this in the car, but when we both agree on something, you guys know you should go the other way, because I think we both said for sure it's bottomed, and sure enough, I lost some fingers when trying to catch that knife, but
yeah, I had my
Patrick had
chainmail
his
glove, but it still stung.
Yeah,
it still stung. I don't want to try claiming that I've gone unscathed with this, but one thing I just wanted to comment here, I'm not impressed with this bounce. Like, okay, for me, one thing that we have seen in so many times in the past, not only in oil, but in so many markets, when you have a massive dump on the downside, often the bounce that we get on the other side has a response that is usually of similar magnitude, not necessarily retrace the whole move, but you have the same type of velocity going the other way. I would have, seeing the drop from 77 down to 55, I would have easily thought we would have been north of 60 on a bounce. The fact that we've only got a couple dollars makes me kind of nervous that this isn't over. I want to see the bulls actually try to really rip this the other way from us to know that a short-term bottom is in. Maybe it's not even in yet. This price action is shit.
Yeah, and what worries me is that the fact that the natural gas, although that spread did blow out and then come back in on Thursday and had one of its biggest contractions coming back in, it went out Friday at the highs of the day, and it leads me to believe that maybe the trader that I'm worried about that's long crude oil, short natural gas isn't done yet. And I think that points to the same thing. Having said that, I'm not as much a technician with the squiggles as you are, so I contend that we might find that all of a sudden maybe it was just cleaning up the end of the week and we're going to come in Monday and everything will be fine. So, I think that I'll be a little more bullish on crude oil than you, and there we go. We have both sides of the coin.
I just want to see more positive price action. That's it. Anyway,
a true technician wants to see. We'll buy it if it goes higher.
I want to see someone else buying it other than me, okay? Anyway, let's
move on to the top 5 things to watch
this week.
This week, that's right.
Right, and so this upcoming week,
let's
call it that. So the top 5 things. So let's start off with number 5.
That's right. I think that one's yours, Patrick.
Yeah, the number 5. What I'm watching is for the financial stability review reports that are coming both from the ECB in Europe, as well as the Bank of Canada, the BOC. What's interesting about this, they only come out twice a year, and it's an interesting thing that a lot of these central banks have started doing, and they come out with these reports that kind of gives you a really nice roadmap as to what they see the risks in an economy. And I've actually enjoyed reading them. For me, being as skeptical as I am of central banks, I do actually enjoy reading these, and I look forward to them. So here's an example of the June financial system review in Canada. And what they'll do is they'll talk about all the different vulnerabilities that they see coming, particularly, for instance, they'll talk about in Canada, they're talking about the elevated levels of Canadian household indebtedness. They talk about the imbalances in the Canadian housing market, cyber threats, operational risks, and they kind of go through all sorts of stuff. I enjoy reading it, and I'm looking forward to it. That's coming out this week for both the ECB and for Bank of Canada.
You know, when you told me that this was something that you enjoyed reading and that this was actually going to be on your top 5 things to watch, I couldn't help but laugh. And I just thought, oh my God, what a geek. First of all, he's like looking forward to something from the Bank of Canada. And I was thinking, oh God, this guy's.
It is actually a good read.
Oh,
you know
okay.
what? You know what? Just because you haven't read it, give it a shot.
Okay,
I'm
going to give it a shot. But this is one thing I want to say. In what alternative universe do you live in that a central bank is actually called something ahead of time in terms of forecasting or highlighting a risk?
It's not a forecast report.
Yeah,
they're talking about the vulnerabilities.
Okay, but
so there's no timing element to it. They're just talking about where they see the imbalances. And to me, central banks always have to look at things as glass half full, and so they're never and so when they're talking about vulnerabilities and something that they're willing to acknowledge is got to be a pretty serious risk if they're not willing to look at it as
well.
Glass
I would
half
say
full.
By the time that they've brought that risk to the forefront, it's time to think about something else, because the chances are it's not going to be.
They actually been talking about it for several years, but even before the top.
Or it'll never happen.
Okay.
That's
all right. Anyway, let's move on.
Okay.
Let's move on. Kev, what do you have as number 4?
Number 4, the high yield credit spread blowout.
Right.
When this is a little bit complicated, or not complicated, but it's something that's a little esoteric. It's the difference.
Do you want me to look at the investment grade or junk?
Well, we can look at them both. Let's start with the investment grade because it's biggest. The biggest mover lately has been this problem with GE. GE is a huge.
That's not investment grade anymore.
Well, not anymore. You're absolutely right.
They've been trading it like junk. Has it officially been downgraded?
Not junk. It's trading. Well,
I heard that it's trading like junk. It's not downgraded there, but it's trading like.
That's correct.
And so I don't even know how to interpret that. That means it hasn't been downgraded, but yet.
Well, it means the market's ahead of the ratings. Actually,
what they're basically doing is downgrading it for the rating.
Let's just step back. What this measures is the amount of extra risk that the market is demanding for you to take. Corporate risk, meaning corporate credit risk. So how many extra basis points over government treasuries are you is the market asking for to take that risk? And what we found is it's been a really tough month. Really tough market in the credit land, and that's
so just to kind of so here, first of all, what you can see is we've gone to about 134 basis points or so in terms of yield that you have to pay to be an investment grade corporate raising over that of Treasury, which is, to be honest, over the history, not exactly an abnormal number. It's just the fact that we're in an upwards trajectory and we're breaking out of 2-year ranges, this kind of 2017-18 range. But also those showing the junk, which is, I think, a much more interesting story. We've been in the 2-year range, kind of bound between 300 to 400 basis points. And in my mind, that 400 basis point is a sort of a line in the sand. Now, do you agree with me in principle that if the spreads continue to blow out, the risk premium that these bond traders are commanding is really because they see default rates going up, and that's often associated with a recession. Is that in line?
Well, yes, I would agree. I would also say that it's a function of the Fed kept raising rates and withdrawing liquidity. And as they withdraw liquidity, there's less and less chairs, and when the music stops, there's less places to sit down.
That's exactly it. But what do you think of the whole problem that David Rosenberg and many others have suggested, which is the big risk is that of the investment grade basket, something like near 50% of it is all BBB rated, which means they're all at risk of being fallen angel status, which is that even though there's this big cohort of investment grade, what if there's this massive tidal wave of downgrades, which basically means the junk bond market actually gets overwhelmed with supply? Well,
and I saw Paul Tudor Jones actually warned about it this week as well.
Yeah.
And I think that the Fed blinked this week. And I think that there was a function of
this
stuff, things like you don't have GE is one of what used to be the largest company in America, right? And their bonds have gone and they've given up kind of 10 to 12% over the last week. And there's real problems, and the amount of debt that they hold is just monstrous.
So when we look at just to do that comparison, so this is the junk bond. So remember, treasuries are rallying for anyone that's on. I'm not going to go and pull them up, but what we have is here. This is the JNK ETF for junk bonds,
right?
Going down HYG if you prefer. You can see again dropping down,
and that represents the spread, and that's why the spread widening
because
right?
the treasury bonds are rallying. Yeah. And the corps are droping, and then you got the LQD, which are the investment grade ETF,
and it's also on the lows, and it's trading like death. Like it's a problem, and you go back.
Does it get worse though? What's your opinion?
It depends on the Fed. If the Fed truly,
you really think the Fed is going to be able, like, if they just pause, you think that suddenly the corporate market is going to be fine?
I think that that'll help. I really do.
I will take the other side of this.
Okay, so I really think it'll help. And then the other thing that we haven't spoken about, and it's going to take too long to talk about, but the whole idea of quantitative easing and quantitative tightening. When they do quantitative tightening, they actually roll their balance sheet off at specific points, and it's not they don't sell; they let things mature.
Right.
The reality is that this week was a huge quantitative tightening day because something like $30 billion came off on this week. I really think that actually affects spreads and it affects the whole market. And I suspect that this week was much worse because of that roll-off
So you
day.
think next week will be a mean reversion?
If I had to, okay, so here you go. I think spreads will be tighter next week.
Okay.
So when we come back next week, you know what we're going to look at? Number
I don't
four?
know if I don't have that short of an opinion.
Yeah.
I just think that these spreads will keep blowing out. We're going to go through a typical business cycle. I don't want to be a doomsdayer about how magnitude of a depth of a recession, but I think we're overdue for some contraction. This is going to all have to play out. I don't think it turns in the bigger picture, but let's see. Maybe you'll be right over the next week. We'll find out.
Number 3.
I want to watch the biotechs. And what's interesting about the biotech space is that, you could go to the individual components, the Biogen, Amgens, and so on. But what's interesting is that when you go to the ETF basket of all these biotechs, they've come to a major support. We've obviously sold off from a $123 high down to almost $100. This is a key support because as a proper technician, if it goes lower, I'm more bearish. But as you can see here, though, if we break this 100 kind of level where all of these prices lie all along here, in my mind, that opens a floodgate where this can really continue to sell. I actually would give it the benefit of the doubt that the bounce holds. I'm not actually forecasting that it will make that break, but it's going to be really interesting to watch this week whether the bulls can hold the line here and support it. Anything that you have a comment on that?
Well, I don't practice the dark art of technical analysis, but I do subscribe to one notion, and that's there's no such thing as triple bottoms and quadruple bottoms. What is that, a quintuple bottom?
Oh, it's just a support line. I don't even want to get into calling it something like that.
The more it bounces off of a support line, it means to me the more it's getting tested and the more that the chances are it's going to break. So although
I would be quite bearish if it did.
Yeah, of course, because you'd be a technician. You'd be selling it. It's going down, so therefore I must sell it. The only point I would say to this is I don't really know. I don't have a view on it. I just know that when something's bouncing along there so often, it doesn't betting on it holding and betting on that, I could see a lot better trades than trying to bet for that thing to hold. And
so now let me ask you this, okay? You're bullish home builders. You're bullish regional banks. Do you buy both of those over biotech?
For sure.
Okay. Let's watch and see whether that plays out. All right, so let's move on.
Okay.
So number 2.
So late next week we get the European PMIs, and this is the purchasing manager index, and I think this is going to be important. We could see a situation where it'll decide if they're going to be able to raise rates in Europe, or if we're going to get in a situation where they might have to kind of put off their plans to raise rates and to stop their quantitative easing. And it's just the PMIs are always big numbers that you should be watching, and you should put that at the top of your list.
So now, do you have any theory as to whether or not a weak PMI is going to weaken the euro? Or do you have any speculation, or are you just looking for the broader economic kind of impact on this?
Well, I do. I'll tell you one thing that I believe is that weak PMIs throughout the world will actually be risk-on events. And the reason that they will be risk-on events is because it'll mean that the central banks and maybe the Fed, like I think in the U.S., for example, bad economic news is actually good news for the market. Because what they were worried about previously was the Fed actually raising rates too tight. So I think that a slowdown in some ways, like there's times when good economics news is good, and there's times when good economic news is bad.
I just don't share your view in general, because I feel that the central banks have to save face, and if Mario Draghi cannot even begin a proper taper and finish any form of tapering without even one rate hike, and suddenly he's gonna go back to a dovish stance and start being accommodated because of one bad PMI print, I think he would lose more credibility than anything else. I think that Draghi is going to continue down the path even if it's weak. So I'll call you out on this one. I don't think that we'll see the response. I mean, maybe you might hear words, but you won't see action. That's what I think.
So you think it's set in stone? He's gonna.
I mean, I think shit has to hit the fan a lot more than just a poor PMI print for him to turn.
I think they're looking for excuses to pause.
All right, well, let's watch and see. This is what's gonna make it so much fun to watch in the next while.
Okay, so what do you got for number one?
For number one is something that I was watching with my members at Big Picture Trading for the last little while, and that's this S&P 500. And going back to some squiggles, there was a Fibonacci zone that came in on the S&P 500 at this kind of 2680, and we attempted to buy the dip, but it's a really interesting question to ask at this stage, is that was this a little short-term swing low, an intermediate to short-term low? Now I am, and I'll openly say at this moment, quite biased that I think that the market is quite bigger picture bearish. I feel that the likelihood that the market makes new highs is not the on balance of probabilities the outcome. I've heard some arguments made as to why it'll be bullish. Guys like Marko Kolanovic trying to call that the pain trade is to the upside versus down, but I think that we potentially have room here for the market to undo the selling from earlier this week, and then we're going to be back towards 2,800. I'm waiting this week to see whether this happens. What's your thinking?
Well, actually, before I go on to my thinking, so do you think it goes above the highs of the last month? Do you think
I think we're going up there now. You as a trader can appreciate that often there's a whole basket of stop losses and all sorts of CTA triggers that will sit above that zone, and so we could have a liquidity kind of event that pops it above 2850. But I don't think anything above 2850 is sustained. So 2820. So I think we're going up there. Along the previous high at 2820. We might temporarily break even 2850 on the interim, but I don't think we're going to 2900.
Well, I at the risk of agreeing with you, which means the market's going to scream higher.
Don't do it.
Yeah, I guess I'm neither bullish nor bearish. Like, I don't think that I have a big, huge call. If you put gun to my head and said long or short, I would choose long right now. I think there's a lot of people that have been looking for a bear move, and
it's not that easy to short when everyone is consensus on this.
And to me, the fact that the Fed is paused, which I know you disagree with, but the fact that they paused, and especially if the dollar can go down, and if we can get oil stabilizing, which you disagree with, but all those things, all those things.
I just want to see better price action. Now, don't give me this disagreement.
Of course.
Okay.
Anyway, after the better price action,
I'm already long. I just want to see it do something. Jesus.
But I just think that if we get a few things can go kind of half right, and all of a sudden, I think the S&P would very quickly be back up, 50, 60 points.
Yeah, I think so.
Yeah.
So we both agree, which is dangerous.
Yeah, which means we're going to be down 100 next week.
All right. So anyway, that's where we have it for the 5 top things to watch next week. All right, Kev, it's coming to the ending of the show, but before we go, we always have the parting wisdom. So what is it that we want to share with everyone?
Well, I know that you're a big fan of Jesse Livermore, so I chose one from Jesse Livermore for you. So, markets are never wrong. Opinions often are.
And I guess our listeners have just gotten about an hour and change of opinions. So let's find out what happens.
Tells you that, you should listen to Jesse Livermore, not ours. And just a big thank you to Naughty Otter Pilsner Beer. Don't forget,
in Canada, our otters are very naughty.
That's right. Make sure you go stop by your local brewery and ask for Naughty Otter.
On a final note, if you did last through this entire episode and did enjoy it, please take the opportunity to share this, follow our YouTube channel as well. Just tweet this out or share it with anyone else that you think would appreciate it. And on behalf of Patrick
and Kevin,
we thank you for joining us, and we'll see you all online next week.
Take care.